The Kindle Report for Friday, March 20th. Welcome everyone, Bob Kindle here. Don't forget to subscribe, click on the bell, and share these videos. Today was one of the very first days I'd have to say the markets acted pretty well. They started to see some stabilization. The basic patterns that were unfolding were positive overall. We saw some early morning weakness, but we quickly remedied that, and markets were trading in a choppy range but finished on the upside. But the stabilization in the pattern, which I'll go through shortly, is a real positive. There really wasn't a lot of news out that would affect the markets either way, really, for the first time. It was an interesting day to watch. The one thing that does continue to happen, and we'll probably see some reprieve, but the bond market continues to be under amazing pressure. And I'm still very concerned about the activity in the bonds. They represent a very risky place right now, even more risky than what the equities were before. We're seeing events, which I'll show you when we go through the technicals, that are really very concerning and suggest that the bond market across the spectrum is basically broken. The Fed continues to attack everything out there with these big numbers and just completely just plow in there. They're just overreacting. Just about everything that's going on in this country right now appears to be an overreaction. The country is being destroyed by all this. This is not going to end pretty, and we don't even know when it's going to end. California is starting to expand, and now you can't go out of the house. The restaurants are going to be closed. I think the date was April 19th. This is insane. When H1N1 was out, there were 68 million people infected. There were over 10,000 that died. It appears that there's something else going on, and there just seems to be a concerted effort to just collapse the economy. You take the state of California and you're shutting it down. You're shutting down. New York is in the same kind of mode, and it's spreading to other states. I don't know how far they carry this, but there's nothing good going to come out of this. And whether we end up in a depression or not, that's hard to say. But the bond market's definitely got lots of issue. And as I've been saying over the past several weeks, debt is okay to hold or to issue and to be obligated to as long as you have cash flow. But they're cutting out all the cash flow. So everything is going to implode. Municipal bonds, I'll show you in a few minutes. Any of the bond indices out there are just getting crushed because it's obvious the income's going to go away to pay the interest. So there ultimately could be major defaults, especially in revenue bonds. I mean, forget those. I mean, they got to be crushed. I don't have a Bloomberg to be able to look at some of these issues. It's big, I guarantee you. And I'm going to research this a little bit as the days go on. But the bond market is of great concern. I would be incredibly careful what you do with those. If you own them, you know, they're always the safe haven. I talked a little bit about the whole 60-40 strategy imploding. The 60-40 strategy is down 19% on the year. All of these strategies, that anything that you're doing trying to offset with bonds is not working. And I don't see that getting any better. In fact, the bond market will be the primary risk. So be very careful in holding those things. Higher the yield, the more at risk they are, the more likely they're not going to be able to pay, especially if these shutdowns start to really expand and get even more serious. I mean, you can't run the country from a Skype account in a bedroom. Okay, it's just not going to happen. But there's an awful lot of people in this country that can't work from Skype or from some sort of webcam. It's just not going to work. So this is going to get really ugly. Every time you think it's okay, it won't be okay. There'll be another wave of selling. And then the last thing that I'll go through tonight is the Dow, and the Dow just continues to surge. And as I mentioned last night, there's just everybody's piling into the Dow. The Dow is still the beacon of the world. It's still the safe haven at the moment. We'll start with the E-mini futures on the S&P, and we've seen a complete recovery. Earlier tonight in the futures, we were down 2%. We are now up on the session by 1%. So there's been a pretty good turnaround. And it's interesting, I mentioned the California announcement about everybody having to stay in their house. That's the only thing I've seen out there if there was a news story to trigger this. One of the things that is likely, we're still under the pressure of the 10-day moving average, which is still dropping sharply. So it's not likely we're going to get above that area today, but we could see the last 2 days high challenge. Let's go over to the cash. We're on the futures here. Let's take a look at the cash. And the key number is going to be at the 25.53 level. That's 150 handles higher. Any other time, we'd be talking about a 2 to 3 week rally. We're talking about tomorrow. The 10-period moving average is going to be the constraint. We should see it bump up against that average in the next 2 sessions. And then the PPM down here, PPM 1 will start to dissipate some of its downward pressure, but it's still down 2.29% per day. The probabilities of getting above that level and staying above it right now are less than 10%. We're going to still have to see probably another 3 to 5 sessions of consolidation and about 2, maybe 3 sessions. We're talking about Monday or Tuesday, we could start to see some movement to the upside. And then we still have other constraints, which are around the 2600, 2650 level. The key today will be that we manage to close higher. If we do manage to close higher, everything will start to set the tone for this 2 or 3 day rally. The last 2 sessions have been the narrowest ranges we've had. So that's a good sign too. We're starting to see the range indicator start to collapse. If we do get a lower range today, then that is also a really good sign. Now we're continuing to see this incredible amount of volume. On Thursday was 8.2 billion shares. This is algorithm trading. There's still a lack of liquidity, but I have seen over the last 2 sessions again a slight improvement in liquidity, especially evident in the futures. We'll find out probably by Wednesday that we will have a low at this 2280 level that printed the other day. So if that happens, then we can start talking about some of the pattern that I drew in. If you go back to Tuesday's video, I structured that all out. I don't want to go through all that detail. It's up there, and it's around 3.5 to 4 minutes. Right there is where I go through all the S&P patterns. Look for stabilization. The key number on the downside for tomorrow is going to be the low of the pattern, which is the 2280, and we're at 2409. So it's a good chance we're not even going to have to worry about that. There is some support at around 2369 and then 2324. But my expectation is that if we do see some weakness, that should hold, and we should start to move up towards the 2450, 2490 level. The way the pattern will set up is we will be at major resistance, worst case by Tuesday. And I would like to see the patterns contract, the volatility contract. That'll tell us that some good things are going on here. And I would like to see the volume come back in too, because that'll happen just because the algorithms won't be pushing the market. And this environment that we're in, anything could come out and we could end up with, a huge sell-off again on a bit of news. PPMs are still under a lot of pressure, so it's going to be just price action we can depend on here. Downward momentum is huge. The trends are down. There's been no change, so don't try to get cute and buy down here. There's no opportunity yet. So let's take a look at some of these bond contracts. This is AGG. It's actually come back pretty good. This is one that has fared fairly well, but you can see the steep drop. All of these markets, including the bonds, should stabilize. Probably going to be a little bit of an uptick. It does look like we're starting to see some pretty good stability. Let's look at a muni bond. This is straight out muni bond. Look how ugly it is. This thing downticked 3.53%. That was for Thursday's action. 2 weeks ago, we were at all-time highs on this bond. So this is a 20% drop. So the bonds are under pressure. California bonds now are likely to be under even more pressure. It wasn't that long ago when this rally was unfolding that you see here, you couldn't be in a better place. These things were working wonderfully, but everything got broken. The equities, the bonds, everything broke at the same time. And this is why I've been kind of beating on the 60-40 pattern that I've been talking about. And in fact, let's just take a quick look at 60-40. 60-40 versus SPX. SPX is down about 26% right now, slight uptick today. The 60-40 is down at 19. And the actual number on this thing is at 19.13. So it's been pretty brutal from the standpoint of what you would expect to see in a 60-40 strategy. There'd be, more than that little buffer that you're seeing here versus the S&P. You've got unbelievable, irresponsible even corporate debt, national debt, personal debt, student loan debt. And now you're going to take the cash flow away from everyone? You're going to send them $1,000 a month? Really? That's going to do something? I don't think so. The Senate passing all these bills and they're trying to throw money at this thing. It's not going to work. You can't shut down this economy. Everything's based upon leverage. And when you take the cash flow away, the leverage breaks. So the system is at great peril yet. Don't think it's going to be fixed here. And there's still going to be wave after wave of selling. I've talked to a lot of advisors, met many, many years ago, and they're wondering what to do. Do you get out? My analogy is we're the family that lives in Florida and there's a hurricane and we boarded up the windows and we're going to ride out the storm. The storm's not over, so it's tough to come out to see the damage yet. We don't know what it is. But I would be careful with some of the bond positions, some stability. You'll be able to lighten up. But these are going to be tough places to make decisions. Do my best to try to keep some kind of perspective. Our average accounts in our system are down between 6 and 8%, and most of those are in cash or 70+%. If you have more cash than that, you just really got to gauge on what the risk is to your clients. These are really tough times. Let's take a look at a high yield, and I'll bounce through a few of these so we can see them. This is a high yield bond. Same thing, just complete collapse. Went from $19 to $15. I mean, these are really, really big moves. Let's take a look at a managed bond. Same thing, this thing, it doesn't matter what it is. Maybe this is a slight better, but there's only so much these bond managers can do. ETFs are not a very good solution when it comes to the bond market. They work. The best money managers out there are in the bond market and when it comes to mutual funds. And those are still a really good place, but there's nothing they can do. I mean, this debt market is imploding, even though the Fed has come in and rescued the commercial market so that the money funds are going to be okay. It's just going to be a day-by-day thing until we can figure things out. And I don't think there's any way to escape the downward risk of the debt. I've said this multiple times, but I just say it again. You can't take the cash flow away from someone who owes debt and expect them to be able to pay their bills. And that's what's happening with virtually everything. Every corporation, anybody that's borrowed money, municipalities, governments, everything. Tax revenues are going to plummet. A quick comment on the dollar. It traded up to 103.8. We're likely going to 106, maybe 110. The momentum here is just off the map. It's straight up. I don't see anything changing this. This is a weekly chart. We're likely to see some profit taking after this surge. We're seeing some downside, but very little right now. Expect the dollar to continue to stay strong. I still think this has everything to do, as I mentioned in the opening comments, of just a flight to the dollar right now. There's nowhere to hide, and this is working. You see this market much different if you're not in the U.S. If you're an outsider, you're buying a dollar. That's all there is to it. This is a way to participate in one market or a safe haven is definitely what this is. This is the end of the broadcast. Don't forget to subscribe, click the bell, and share the video. We'll talk to you on Sunday night.